Hey, good morning, friends. I'm here with my good friend and partner, Matt Snyder, and we're coming to you from our headquarters here in Brownsburg, Indiana.
And I'm here with Matt Teeple, the founder of Teeple Snyder Newsome Wealth Management, and I'm excited to really dive into some of the content that we've been discussing with our clients and a lot of the questions that we've been getting. This is a really odd time, economically speaking.
Sure is.
I don't know if I can think of a time, at least since I've been working as a financial advisor, that we've had an economic climate as confusing as this.
There's a lot of mixed indicators, and I think investors have just been behaving quite irrationally, quite frankly. It certainly is an unusual time.
So you say they're acting irrationally, but at least what I'm seeing in the headline news, all the articles out there right now, corporate earnings reports, I mean, they're coming out really strong. Yes, the stock market's running at an all-time high, but you're telling me there's a disconnect there.
Yeah, absolutely. And anytime you beat an estimate, you have to think about what that estimate is and what bar has been set. Corporate earnings have been beating expectations over the last number of quarters, but all the way back to Q4 2022, earnings have actually been in decline, and yet stock investors are bidding prices up. And even as a small business owner here, if my business would sell today for a certain amount of dollars, and my business does 10% less in earnings this year, you wouldn't buy it for the same price a year from now if my earnings went down. And yet that's exactly what investors are doing.
Okay. And so this is what you're telling me is it's tied to a valuation of some kind.
Absolutely.
And so valuations right now within the market, you're saying they're running high? I mean, what basis are you founding that on?
So if you're really getting into security analysis, you need to go company by company by company. What we're talking about is the stock market at a very high level, right? And so you've got to have some kind of way to compare current prices historically to how they have been. And at the moment, the S&P 500, a collection of 500 of the biggest companies here in the U.S., is trading. You pay about $20 in share price for every $1 a company earns. Now, is that expensive? Is it fairly priced? Is it cheap? What I can tell you is that aside from the couple years coming out of the massive stimulus from COVID, a 20 price to earnings multiple is the highest it's been since deflating out of the tech bubble. We're at high valuations, as high as they've been in the last 25 years, except for that COVID anomaly.
Okay. Well, so corporate earnings may not be the best indicator here, it sounds like, if they haven't actually been earning as much as they used to.
Correct.
Even though they've been beating expectations. That's kind of an arbitrary point. But the consumer, unemployment, I mean, these things are just in really healthy conditions, right? I mean, consumers have been spending like crazy.
Right.
Consumer spending has just shocked a lot of economists for the past 2-3 years now.
Yeah.
And
Yeah.
so if consumers are going to keep spending, corporations are going to keep earning, right?
Well, in theory, if consumers keep spending, the question is, will they? And do they have the means able to do so? So again, I go back to the big anomaly coming out of COVID. We had two presidents. This is not a party thing. This is two different presidents that injected $5 trillion of stimulus into the economy. Now, that has never been done before. In fact, I was an advisor back in 2008 when we had the financial crisis, and I remember people up in arms when we passed, an aggregate of $1 trillion of stimulus. Well, now we're 5x that. And I was telling clients when this came out, if you lined up $1 bills, 5 trillion of them, it would be enough to go to the moon and back over 2,000 times. That's the mountain of stimulus. So of course, clients were flush with cash and they've been spending money. I mean, that just makes sense. That drove our inflation. Now we've been doing what we can to bring inflation back down. Unemployment has been low because everybody's flush with cash. The question is, what are the lingering effects, and is that used up? What's the health of the consumer at this point? And what are your thoughts on that?
Well, yeah, the health of the consumer right now, as we're going over answering some questions that we're working with clients on right now, consumers don't seem to have nearly as much cash as they had
Right.
A number of times, whether you're talking to an individual or if you look at the U.S. aggregate as a whole. We had upwards of $2.2 trillion in cash in 2021. and now we're at roughly 0.4 trillion. So we spent
In savings,
in
the
excess savings. Yeah,
correct.
not income, but yeah,
Right.
it seems like a lot of the extra cash seems to have
Yeah.
dwindled over the past couple of years.
In a lot of ways, what I think it's like is we are back to living paycheck to paycheck. And my concern is if people start to lose jobs. Right now, almost everybody who wants a job has one. I mean, we're at almost record low unemployment rates. So my concern is if that ticks up even a little bit, I mean, what's that mean for GDP? What's that mean for the economy? What's that mean for corporate earnings if the economy starts contracting? I mean, yeah, we are growing earnings again by a little bit, but it's nowhere near the excitement I see on Wall Street. Well, not even Wall Street, Main Street. It's the retail investor that has just been bidding prices up, chasing returns. I think they have a fear of missing out, Matt. I think they're chasing those big numbers, and that has them excited right now.
Okay, and so this is also a year for an election,
Yeah.
right? And that's usually a good thing for the stock market, right? So shouldn't we
Yeah.
be pretty excited about participating in the market right now?
Well, that's a good question. What the market doesn't like is unknown surprises. So I think the closer we get to the election, if we have any kind of surprise, the market's going to go into a tizzy. In fact, I remember when the market was surprised that Donald Trump was going to beat Hillary Clinton. And the futures and I mean, this was 11 p.m. I'm watching whatever on election coverage. And the stock futures plummeted. And then 12 hours later, when the market opened, the Dow was up, I don't know, 2,000 points.
Yeah.
So I would not get too concerned about the short term. Those things both normalized over the long term. And yes, you are right. The election year and the political cycle, we got 4 years. The election year is the second best. But the question is that really causative, if that's even a word? Is that causing the great stock performance, or is there other things driving? And right now, I would say you always want to look at the fundamentals. You always want to look at the fundamentals. But honestly, I'm not afraid for the long term on who's in office. I think there's so many variables. And if you look long term, in fact, I think we have a chart on this that we're showing clients that whether it's a Republican president or a Democratic president, the market has gone up. And if it was clearly red is bad and blue is good or vice versa, then we would pay a lot more attention to the market because that would be one of the fundamental drivers. But I don't think it is. I think it's macroeconomics and corporate earnings and all the things we're chatting about right now.
Yeah, and so these are a lot of the questions we're working with clients on a daily basis. I mean, in real time. And so I guess how are we actually implementing any of this information? I mean, information's useful, but how are we using it?
No, that's a good point. So we're collaborative here at Teeple, Snyder, and Newsome. We've got 9 advisors and sitting in 3 different cities, and we're running through the macroeconomics and allocations on a monthly basis in our investment policy committee meeting. So we're all giving similar advice. And what that advice right now is, don't swing for the fences, right? Warren Buffett always says, buy when people are fearful, sell when people are greedy. Well, I see fear of missing out syndrome big time right now, and the markets have gone up. Don't chase returns. This is the time that we're telling people there's not a lot that makes sense right now. So those paper gains that you have, why don't we trim those profits and rebalance and diversify and put them into things like T-bills? I mean, T-bills are yielding almost 6% right now. They're almost as risk-free as your money market account. And we can earn 6% on those. I mean, that's a great alternative to stocks right now in this environment. So I don't want to swing for the fences when markets are on an all-time high. I would rather trim some profits, re-diversify, and not because I'm overly conservative in nature. I would want to go bargain shopping in stocks when the time is right. I just don't think the time is right.
Yeah. And so T-bills are pretty clean cut, right? They're pretty boring, still yielding a really good interest rate right now, much better than they have over the past couple of decades, really.
Well, boring to a lot of people. I get excited about 6%.
I know, if you can guarantee it, that's fantastic. Is there anything else out there? I mean, you've got stocks and bonds. Is that what we're working with in client portfolios, or?
Stocks, bonds, and alternative investments. I mean, when you're talking about diversification, spreading your eggs across many different baskets, what you don't want is them to all be moving in the same direction at the same time. I mean, that's great if everything is going up, but if you have a year like 2022 when both stocks and bonds were down, everything going in the same direction really would crush the portfolio. So we're looking for things that are not correlated to those traditional stocks and bonds. Things like hedge strategy funds or private equity. Private equity is a great asset class. It's similar to stocks in that it is ownership in a company, but rather than having daily price fluctuations pushed around by emotional investors, private equity is a little less liquid, but historically it's had a higher return. You're getting a liquidity premium, and the volatility is so small. I mean, it's
much lower,
almost like a bond, and yet you're getting premiums to stocks. So things like that, I think we add a lot of value, and so we're underweighting stocks. We're putting money into T-bills. We're looking at alternative investments, and even within stocks. I mean, what's your feeling? Is there strategic movements we can make within stocks to take advantage of value that's out there?
Yeah, and so valuation, as you pointed out, the S&P right now is running on an expensive side, but the S&P is so heavily concentrated in a very handful select growth stocks. Very tech heavy, very heavy in artificial intelligence. That's definitely the buzzword going on right now.
Right,
and
for sure.
all the investors, especially a lot of the retail investors, are leaning on one side of the boat right now. So that leaves another side of the boat that, for the most part, has become very reasonably valued or even historically undervalued in this environment. Some value type stocks and even international stocks. No one's really talked about international stocks for, I feel like, the past decade. They haven't been all that interesting to talk about, but for the first time in a long time, they're starting to see some a valuation appeal, definitely.
Absolutely.
In this segment of the market. And so doesn't mean that you have to jump out of the stock market, right?
Absolutely.
You can definitely do some value hunting. I know Warren Buffett, like you said, he's been around the block a few times, and he knows what he's doing.
Yeah.
And so definitely taking a hint from someone who has a long track record is definitely a good long-term strategy.
Oh, absolutely.
So.
Well, it's good to chat with you, Matt, and share this and share with you what we're talking to our clients about. What encouragement would you give somebody who's nervous about what's going on? Could we help them?
Yeah. So working with a financial advisor is a core element of that is just to have a sounding board, someone to come to, get some input on some of these topics so that we're not making irrational moves, both for market strategies that may be overvalued or overweighted in a portfolio, someone who can help diversify, stay steady, keep a calm hand in a big storm, so to speak. There's a lot of volatility going on in the market. Ups are way up and the downs are way down. And so we definitely like to communicate with our clients on a very regular basis, as often as quarterly, meeting with our clients in person. And so that's a strong priority for our firm. And I would really encourage you to use the link below if you have questions or would want to even learn a little bit more about who we are, what we do, our fee-only model that a lot of people have come to know and love. And so feel free to use the link below or reach out, give us a call. We'd love to talk with you.
Yeah, we're family around here. We'd love to talk with you. Thanks for bearing with us. This is our first crack at a YouTube video. It won't be our last, I promise you. So if you see this and like it or found it helpful, subscribe, like it. But we certainly hope to hear from you. Thank you.